Right now, the pound is on life support. In just a single year, the pound is down more than 20% against the dollar at levels that we've not seen since the 1980s.
Lower, actually, maybe we can show you a chart on the screen because it is quite dramatic.
It's losing its buying power faster than the new government's reputation, and things could get even worse from here if action isn't taken immediately. Just last week, the new Chancellor announced some drastic changes to taxation, bankers' bonuses and stamp duty in what's been dubbed the budget for the 1%. And now the charts for the pound look more like a meme crypto token rather than a serious national currency.
Ow! It went to zero! Yeah!
Without boring you with all the details on the mini budget, the thing I wanted to focus on today for you is how the weak pound could affect investors. More importantly, I want to address some concerns that new investors might have and also share some of my own thoughts about what options you might have to protect yourself in an environment like this. I'm sure there are loads of you out there thinking, isn't it typical that the moment you wanted to get started investing, your own currency crumbles underneath you? Pretty annoying. And don't worry, I'm not a doom and gloom merchant, so I'll try and keep things positive. Let's keep it simple so we can all understand what's going on. Do we run away, pull the plug on the pound, or hold out and wait until things are strong and stable again? Let's find out.
But that is a sign of investors out there being worried about sterling.
First up, let's just remind ourselves that like any other asset, like stocks, gold, and the price of your house, everything is determined by the market. Pure supply and demand. And currencies like the pound work in exactly the same way. If there's more demand for it, then its value will increase, or at least in relation to other currencies in the world. So imagine it's just one big market. Now, over quite a few years now, the pound has been falling against not only major currencies like the dollar, but also against the euro too. And as I write the script for this video, the pound is only going to get you $1.07. And it was even as bad as $1.04 in the early hours of Monday morning when markets opened in the Far East. Basically, at the moment, the market is saying the pound isn't worth much and will probably get weaker because we've just given out massive tax cuts out, which will actually make inflation worse. And to combat this, the Bank of England is going to have to increase interest rates, making borrowing more expensive for both consumers and the government themselves. But why does all of this matter? You might think, you live here in the UK, you get paid in pounds, you spend your pounds, so unless you're going to have a holiday in the US, you've got nothing to worry about, right? Well, unfortunately, interest rates are going to affect you whether you like it or not. And one of the reasons the strength of the pound is so important, especially against the US dollar, is because the dollar is the currency that global trade is heavily based around. Whether it's oil, gas, or other commodities like coffee and chocolate, the US dollar is how things are priced. So what this means is that in the example of oil prices, you've not only got to look at the price of the barrel of oil as the example, but if our pound has just lost 10% of its value against the dollar, our price that we pay has just gone up by 10% as well. So recently, you know when it was above £2 a litre for fuel, and for anyone outside the UK, that's over $10 per gallon of fuel. We not only suffered because of the increase in the fuel price, but we also suffered as the pound was losing its value too. Not to mention the fact that energy costs also rely on us having a strong currency to purchase wholesale gas on global markets to heat homes and businesses, and you've got yourself a little bit of a sticky situation. It's not all bad though, there can be some positive to this. If you were thinking of doing an epic Euro road trip from the US, then now's the time to do it. You've basically been given a 30% price cut on your holidays. And also, if you export anything as a business from the UK, especially to the US, it's now cheaper for your customers. However, it might not be great for you as you've probably had to pay more for your parts to manufacture it, but hey, at least it's something. So really, it just depends on the direction of travel and who's buying from who, as like we just said, it's one big global market of currencies and they're just one part of the puzzle. From an investing standpoint though, as many of you might have noticed recently, having a weak pound has actually made your investments into US companies look a lot better than it actually should. For example, on my recent portfolio updates on Vanguard, when you look at the performance of popular ETF VUSA, which is just a fund that invests in the S&P 500, you'll see that year to date so far, it's down around 4%, whereas the S&P 500 itself, if we compare it to a US-based ETF like VOO, says it's down more than 23%. The only difference is the currency. As you can guess, if you've invested in US stocks which trade in dollars, and the pound has been falling in value against the dollar, you've actually gained value in your investments even though they've also been falling in value too. However, yes, I know what you're thinking, you're right. If you haven't yet invested or you're about to invest once you get paid at the start of next month, then yes, you'll also be technically paying more than you would have before. As usual, it swings and roundabouts. Sometimes it works out well and other times not so good. It works the same if you've also been looking at buying up any US stocks individually, especially some of the big name tech stocks currently sitting around 52-week lows. Although it looks like there's some great deals out there, you'll now be paying more of your pounds to get the same amount of shares that you might have been able to buy before. So the bottom line is, it depends which direction you're going, but it doesn't have to be all negative. Also, if you're an investor from outside of the UK, UK stocks and UK assets could start to look pretty attractive. There's lots of companies that generate a ton of cash on the FTSE 100, and also don't forget about big money in commercial property and even residential real estate. Anyone looking to buy from outside the UK has been given a 20% discount coupon since the start of the year. Unfortunately though, if we do start to attract lots of outside investors into assets like property, then it will also add to our already big problem of inflation, which is forecast to peak at around 14% by the end of the year. Ouch.
We are going to get rid of it.
So with all of this said, what can we do as both investors and generally to protect our cash and keep trying to grow our wealth? I'll be honest, there's not a huge amount you can do, but let me at least try and focus on some options. Firstly, I don't think there's ever been a better time to pay down any debt you have, especially anything on credit cards or anything outside of a mortgage. Because there's basically nowhere to hide and every asset's been falling in price, if you did decide to pay off some credit card debt or even a loan that was on 8% or even 10% interest per year, paying that off early is exactly the same as making returns in the stock market. I know it might seem like personal finance 101 and really basic, but you can easily forget about that. So don't ignore it, even if it's a small amount, get it paid and consider it an investment because it's about as good of a return as you'll actually get right now. Next up, if you are worried about currency changes affecting your investments for whatever reason, and you also might have different goals or different risk tolerances, there is always the option of using hedged ETFs. Now, I'm not going to pretend that I'm an expert here or that I use them myself, but they are available to investors if you want to invest in the S&P 500, for example, and follow the performance of that index without worrying about converting everything. The problem is, at the end of the day, you can't escape the fact that even US-based companies on the S&P 500 still need to generate a big part of their income outside the US, so they'll always be exposed to exchange rates whether you like it or not. And if you're buying something regularly over a long period of time, then exchange rates are always changing. So use this option at your own discretion, but I just wanted to highlight in case you were interested. You might also think, well, what if I just invest in the UK and never bother with things in dollars? Unfortunately, there's virtually no way to do that. As I've mentioned many times before, the top companies on the London Stock Exchange make most of their money outside of the UK, so their profits, which they might make in dollars for example, have to be turned back into pounds at some point. So sometimes it's a good thing, and sometimes it's not so great. And then even if you just invest in companies who only traded in the UK itself, well, you still can't really avoid exchange rates because ultimately there's lots of goods that we need outside of the UK to bring in, which are all traded in dollars. On a slight side note, I do think that this is a massive reminder of how important diversification is for your investing portfolios generally. By making sure that you invest broadly in as many different sectors, countries, and companies as you feel comfortable with, and also doing this over the long period of time regularly, you'll be able to smooth out any of these highs and lows. If you concentrate your portfolio and just invest in one company because you think it's going to the moon, then you can end up putting yourself in a very risky place. There's also been some talk recently of something called the lost decade, which seems to pop up every now and then in the media. It's definitely nothing new. And basically, it's talking about flat or almost no returns for a 10-year period, which have happened multiple times before. But in short, without going into too much detail, they fail to appreciate that even in a flat market or a big peak to peak through a massive dip, if you invest regularly rather than just one time, you'll end up making money, and that's not even mentioning reinvesting dividends. And also, no one knows what's going to happen. Now, what about staying out of the market then and just waiting? Well, I totally get why a lot of people are going to feel this way, and it seems perfectly rational, right? Wait until things get better. The pound is so low now that it's only going to go up from here, surely. And there's loads of other bad news out there in the global economy that just means that we're going to be heading for a crash, so hoard all of your money and sit this all out. And while all of that might be true, here's the difficult part, because now we're in the territory of trying to time the market, which is exactly what some of the best investors in the world tell us time and time again not to do. Put it this way, let's say we do sit out on the sidelines. At what point do you feel comfortable investing again? 10% improvement in exchange rates? 20% maybe? Or maybe you also want to see 10% lower on the S&P 500? At what point does it make sense to you? You probably won't get the bottom exactly, but how close can you get? What happens if the S&P 500 keeps rising, but the pound stays low for many months or even years? All of that time, you'll be out of the market, in cash, which feels comfortable and safe, but you're still losing value for inflation and opportunity costs as well, potentially every single day. And then, let's say you do want to invest again, and you think prices look good. Are you going to lump sum invest all at once, or are you going to take it easy? And why would you choose one either way? Now, let's also not forget that the stock market is a forward-looking market. It trades on future value of an asset and assumptions we make about the future, and especially like certainty. So how will you know when things are looking certain? You see how things can start to get really stressful if you want to time the market? The prices on the stock market don't suddenly correlate based on a single factor. It's just its own beast. And in the short term, it can act as irrationally as it wants. It's going to take a pretty level head and strong stomach to get through the next few months and maybe even the next few years for us investors here in the UK. But yet again, one of the best ways to do this, if you're building wealth for the long term, will be to just continue on investing regularly throughout. Times like these are really hard to get through because every emotion you have is telling you that you have to do the opposite. Sell everything and sit it out, when it's actually the worst thing you can do if you want a dollar cost average into the stock market. For sure, individual stocks are different and you can definitely wait until prices look good for you, but stopping a regular investment during periods where the market's going down is how you end up with the average retail investor losing to the market over many, many years. You only get the cheap prices in the market if you actually invest during times when there's a lot of fear and uncertainty. And you can only do that if you take your emotions out of the equation and you just keep following your plan. Remember again that nobody knows the future, and especially what the stock market's going to do and how it will react to things. Unfortunately, there are plenty of people on YouTube who will claim to know what to do, and they'll put so much fear out there that you'd assume they'd never invest a penny. You can bet that in the background, all of these doom merchants invest consistently into index funds when they tell you that you should just all wait and cash. Maybe that's a good exposed video we could do one day. So until then, I'd never try and tell you what to do. Everything is up to you when it comes to the whole personal finance game. And if you want to sit it out, then that's all up to you. But just remember that if anything was easily predictable with investing and how certain things behave, then it wouldn't work because everyone would just do it and it would remove any kind of advantage. For all we know, the pound stays at these levels for ages, or the government does something crazy and it jumps again. None of these events are predictable, but at least they give us something to talk about, hey?
We are going to get rid of it.
Anyway, until next time, happy investing.